So in the last class, we started bond valuation and we solved 3 examples showing us how to estimate market value of a bond. In today's class, we are going to move to yield to maturity. I told you the parameters, right, for evaluating bond and what a typical bond valuation question could revolve around. I said you could have market value of the bond. That is, they can ask you to calculate market value. They can ask you to calculate the yield to maturity. They could ask you to calculate the bond duration or Macaulay duration, and they could ask you to calculate the modified duration. Okay, so we did market value of the bond. We solved 3 questions, and today we are moving to the yield to maturity. I said in the previous class that yield to maturity is the same thing as cost of debt. Okay, so let's just go straight into solving questions. This question says a 3-year 5% coupon, I'll put it on the screen, corporate bond with 100 naira face value redeemable at par has the following spread above the treasury spot rate given below. So they said the year 1, year 2, and year 3. They gave you the credit spread 29 basis points in year 1, 41 basis points in year 2, 55 basis points in year 3. They gave you the yield coverage 3.88% in year 1, 4.96% in year 2, and 5.80% in year 3. So let me just briefly say that yield to maturity, like I said, is cost of debt, right? So this yield to maturity, how do you calculate yield to maturity? You know, a bond can be irredeemable and it can also be redeemable, right? So for a redeemable bond, remember when we're doing cost of debt, that to calculate the cost of debt, which is the yield to maturity, it is what? IRR. Remember? Now for an irredeemable bond, to get your cost of debt, which is your yield to maturity, is what? Interest over market value. Here, no tax. Don't do 1 minus T. And the assumption, which is actually the usual thing in practice, is that the bondholder, that's the investor, would pay tax. Okay? But you know, in cost of debt, you don't 1 minus T because in the account of debt issuer, which is the company using that debt, interest is exempted from tax, as in interest is a tax deductible item normally, right? So you don't put 1 minus T here. So after reading that question, after reading this question, what did they say we should do? Let me read the requirements. Okay, so the requirement is value the bond based on the corporate spot curve. They're asking you to calculate the market value of the bond. Okay, and you know in last class we said market value is what? We said market value is what? Present value of future cash flows. What does that mean? It means you are saying a particular cash flow times 1 plus r raised to power minus n, as in you are discounting, right? Present value of future cash flows. So now this r is the what? Yield to maturity. What are you using to discount? This is the formula. Yield to maturity is equal to what? Your risk-free rate plus your credit risk premium. When we're doing cost of debt, there is a way we estimate KD from the capital asset pricing model, okay? That says risk-free rate plus credit spread. So this one you can also call it the credit spread. Credit spread. This is risk-free rate. You can also call it the yield curve rate. It's also called yield curve rate. So there are different terminologies that you can come across in questions. So this approach is telling you that the yield to maturity, this R, which is the discounting factor, is not usually constant every year as we assumed. Sometimes you need to consider the credit risk premium. You add it to the risk-free rate. This risk-free rate is government rate on treasury bills, the minimum, okay? Now, so because it says you value the bond based on corporate spot curve, that is by discounting with the yield to maturity rate per year, you now say in year 1, right, your yield to maturity, which you use to discount, is what? Risk-free rate or yield coverage at 3.88% plus your credit spread, maybe as 29 basis points. 29 basis points means 0.29%, right? Remember when we were doing cost of debt, I told you when you saw like 29 basis points, all you need to say is 29 over 100 and put your percentage beside it, right? Then for year 2, your yield to maturity, what you should use to discount in year 2 is what? Your risk-free rate, which was given to you as 4.96% plus 41 basis points, 0.41% equals in year 3, your yield to maturity, that's what you should use to discount, should be 5.80% plus your credit risk spread, which is given as 55 basis points, 0.55% equals, so let me get my calculator and solve all of this. 3.88 plus 0.29 is what? 4.17%. This is what you use to discount in year 1. You can see it's not constant all through the years as we assumed. Okay, so 4.96 plus 0.41, that will give you 5.37. 5.8 plus 0.55, that gives you 6.35%, right? Now, when you have all of this, you go and value the bond. When you say value a bond, that is what is the market value, what should the debt holder pay to buy the bond, okay? So you know how we value bond normally, right? Yeah, okay? Valuing the bond is present value of future cash flows. What am I getting in the future? Coupon, and redemption. So they said the coupon is what? 5% coupon, that is, they are receiving interest of 5%, okay? So, details. This one is saying what? Coupon, 5%. 5% of 100 naira, that gives you what? 5 naira. Cash flows, 5 naira, right? So, this is in year 1. Don't say year 1 to 3. You can't say year 1 to 3 because although the cash flows are constant, the discounting factors are not constant. So, you can't use annuity table. Annuity table, what rate are you going to go for? Do you understand? So, in this year 1, you are multiplying by what? Discount factor at 4.17%. Okay, so that will be 1 plus 0.0417 raised to power minus 1. Does it make sense? So in year 2, your coupon will be what? 5. You multiply by 1 plus 0.0537 raised to power minus 2. In year 3, they are telling you that the yield to maturity appropriate for that year is what? You have your coupon. You know here there will be redemption because it's 3 years, right? So it's coupon plus redemption. And they said it's redeemable at what? Let's check it. Redeemable at par. Okay? So it will be 100, you get 100 and you get your 5 naira. 100 plus 5, right? Times 1 plus 0.0635 raised to power minus 3. Now you get your present value. Right? So now let's put all of this in our calculator, okay? This one like this is 1.0417 raised to power minus 1 times 5 for 4.799, that's let's say 4.80, okay? This one is 1.0537 raised to power what? Minus 2 times 5, that gives you 4.50. Okay, then 1.0635 raised to power minus 3 times 105, that gives you 87.29. So add it to 4.5 plus 4.8, that gives you 96.59. This is the market value of the bond. This is what the bond holder will drop to buy 100 naira face value of the bond. Do you understand? So this is what the value of the bond, okay, or what it is trading at in the market. So you have solved the key part. Sorry guys, I've been under the weather. I can see that my vibe today is just, but we'll get the groove back. So they said estimate the bond yield to maturity. The bond yield to maturity. Now when you say you estimate the bond yield to maturity, they are asked to calculate the IRR. So IRR is the rate at which the present value of the outflows will equal to the present value of the inflows. That is a rate at which the MPV will be 0. Okay, so remember how to get IRR. Remember the formula: lower discount rate plus MPV of lower rate over MPV of lower rate minus MPV of higher rate into higher rate minus lower rate. When you write the formula, ask yourself, what is my lower rate? You don't know once you go and start by discounting with your coupon. Okay, so we are already in B. Okay, so you say your year, right? Year in year 0. So here you're starting from year 0. You are describing like the whole life of the bond and everything that happens. So in year 0, you are going to have what? The market value. The bond holder wants to buy the bond. Okay, so you have your market value as what? 96.59, right? The starting factor at what? Coupon, which is what? 5%. You know it's going to be 1.000, right? At year 0. Then you have it to what? 96.59. This is an outflow when the bond holder drops this money to buy the bond. You know I said yield to maturity is from the point of view of the bond holder, the investor. So it's trying to calculate his IRR. Okay, so between year 1 and year 3, he's going to receive coupon, right, of 5 naira. But discounting at 5%. understand. Here you need your annuity table because it's one discount rate, constant cash flows. Okay, where's my annuity table? So we're looking for 5% under 3 years. That gives us 2.723, right? So we have 2.723 multiplied by 5. 2.723 multiplied by 5. That gives us 13.615. Or just say 62. Okay, 13.62. Then in year 3, at the end of year 3, there will be redemption, right? Redemption at par 100 naira. So this 100 naira now, you discount. You know, this one you can't do annuity because it's just a single year. It's not a cumulative cash flow. Okay, it's not a cumulative cash flow. It's just a single cash flow in a single year. So 1 plus R 0.05 raised to power minus 3. So 1.05 raised to power minus 3. That gives us 0.864. 0.864 times 100. Okay, that's 86.40. Okay, plus 13.62 minus 96.59. That gives us 3. That gives us 3.41. Okay, 3.41. See, this is the NPV. This is the NPV. If this is the NPV, assuming that you are discounting at coupon, you got a positive NPV. Now you want to get a negative NPV. You can see you got a positive NPV. You want to get a negative NPV. To get a negative NPV, I told you in cost of debt class that you would increase the discounting factor. Just double it. Okay. So now discount at 10%. You understand? So between this 5% and 10% is where you find your yield to maturity, your cost of debt, the required rate of the return of the investor. So that's what this guessing is like. You're extrapolating. Okay, let me not say that. Let me not break it down. But even myself, I try to allow these things to make sense to me because there are so many assumptions. Okay, so here you go normally here you have your 1.000 and then you have what? Your present value to be what? 96.59. Now here your discounted factor for 10 years, 10% should be what? 10% under 3 years. That's what? 2.487. 2.487. And for here, you have 1.0.10 raised to power minus 3, right? So 1.1 raised to power minus 3. Now like 0.751. Yeah, it's very common. 0.751. Right? So multiply by 100, you have 75.1. Multiply this by 5. That is 2.487 times 5. So you have 12.44 instead of 15 naira. 5 times 3 years normally, but because you have discounted present value to reduce, so 75.1 equals minus 80 minus 96.59. Now that gives you a negative of minus 9.06. So you have a negative NPV. So you can bring it into your formula because you have all your variables. So what is the lower discount rate of these two? 5%. Plus NPV of the lower rate, we got 3.41, okay, minus lower rate NPV 3.41 minus NPV of higher rate, see the NPV button, minus 9.06, okay, higher rate 10% minus lower rate 5%, then you put this in your calculator, okay, so this one, start with this one under, that's 3.41 minus, that's plus 9.06. Because they say 3.41 divided by answer. You have 0.10 multiplied by this one will be 5%. Multiplied by 5, then add to 5. That gives you 6.36 or 37%. Okay? So the yield to maturity is 6.37%. Right? If you use this rate to discount the cash flows, you get your NPV to be 0. You can try that. So we've solved this question. Now when you're trying to get IRR, your answer will always fall between 5% and 10%. As in the higher rate, the lower rate and higher rate. So when you're getting something like 15%, you know that your answer is wrong. So we are done with this question. If you have any questions in the comment section, please just leave it in the comment section. Now let me say something. Sometimes they won't give you these risk-free rates. They won't, you know this risk-free rate is government rate on treasury bond. Sometimes they won't give you the government rate. They'll tell you to calculate the government rate. Sorry guys. They'll tell you to calculate the government rate. They'll give you the market value of government bonds. And they'll give you the market value of government bonds, what it is trading at the market, then they'll give you the interest, right? You now say you should calculate the risk-free rate. Sometimes they will hide the risk-free rate. Just always know this formula, that is market value of bond, is what? Interest. This is a future cash flow multiplied by what? Discounting. That discounting, once you understand this, you know that this is the risk rate you are looking for. When they give you market value of government bond, then they give you their interest, that is their coupon. You can always get the R, because they will tell you the number of years. Okay. Now, tomorrow's class we've done this, so we'll move to bond duration or Macaulay duration and move to modified duration. So let me explain that one briefly so that we will not explain in the next class, we'll just go straight into solving. You should think that duration of the bond should be the normal end, right? But the duration of the bond is the actual time it takes the investor to recollect or to recover his money. Yeah, to recover his money. So usually when they say the bond is for 3 years to maturity, most times it will be like 2.8 years. In 2.8 years, he will recover his money, okay? SFM is full of assumptions, so just learn it like that. But that's what the duration of a bond, or the Macaulay duration, is always saying. And the formula to get the duration of a bond, the duration of a bond is equal to what? The sum of the weighted PV of future cash flow. We'll solve examples on this for I'm just explaining over the original investments, okay? The amount that the investor dropped, okay? Then the sum of the weighted PV. Do you understand? So this modified duration, I'll explain better tomorrow, but let's just talk about it. This modified duration looks at the relationship. This duration is in years. Your answer is always in years. The modified duration, your answer will always be in percentage. That one looks at the sensitivity of the bond. It looks at the relationship between the interest rate and the bond price. And there's always a negative relationship, that is an inverse relationship. It makes sense to say that if interest rate goes high, the bond price will go so low. So when we are solving questions tomorrow, you would understand all of that, okay? So thank you so much, guys, for watching. Share with anybody that's going to find this useful. Give it a thumbs up. That's how I know if you really liked it, okay? And I'll see you in the next class, where we do duration and modified duration. And then we have one more big example. And then that will be the end of bond valuation. And then we move to investment appraisal. Thank you for watching, and bye!